Welcome to my channel. I'm Dr. Romano. Have you ever wondered what's the difference between a hedge fund and an investment bank investment? Well, there is a great difference. Mutual funds are very different compared to hedge funds. In this video, I'm going to walk you through on those differences based on what I've learned in my PhD. As a PhD graduate, I studied the returns of hedge funds because I used to work for an investment bank in risk management in the chief financial office. And my particular job was to review the trading books on a daily basis. Before we continue the video, please remember to do thumbs up. It's right there. It doesn't hurt to press that button, but that will really help me out. And also, subscribe to my channel, please. That will also help my channel out. You're gonna get my future videos anyway, because that's how the algorithm works once you click on one of my videos. But if you subscribe, at least I'll get credit for it. Thank you so much. It was an incredible experience that I received, and I was very, very lucky to be a part of that era where you actually have to check for fraud, and you also have to make sure people update their books, because not everything was automated back then. And it was an incredible difference compared to today, where a lot of stuff is automated. You haven't seen any mergers happen in a very long time between the investment banks. But at that time, investment banks were merging together, creating the big companies they are today. And that was actually their downfall because they were so big. And then, of course, in 2008 and 2009 era, the government had to lend them money to stay in business. Of course, Warren Buffett purchased Goldman Sachs, Bank of America purchased Merrill Lynch, and the other banks, either they survived or they went bankrupt because they were heavily involved in the risk assets that they chose to invest in. Now, hold that thought. So in other words, an investment bank has a team of 90 people back then managing the risk of the company. That's the team that I worked on. I worked for risk management, and my title was a risk analyst. Because of that position, I learned a great deal on how exactly does an investment bank manage their risk. At that particular time, people thought that the investment bank was a for sure investment and that it was safe to invest in them. And a lot of people, actually most of the population who have pensions, they had their pensions at the investment banks, whether it was in a mutual fund or whatever it was. Now let's step back in time. The reason why investment banks got so big in the 1990s is because the government changed the law in the early 80s, late 1970s, because the policies of the government changed. They were going to do trade deals with other countries, and because of that, our factories started to leave the country. And this was a major change that happened. No longer could the federal government help other countries by lending them money and forcing them to buy our products. That era ended. Remember what happened in the 1940s? The US became a global power. And because of that global power, they pegged the dollar as the reserve currency. And again, it really affected our economy. Because of that war era, our government was lending money to other countries that needed help to rebuild that country. And in return, as I mentioned, they were forced to buy our products. It's so familiar how things are just a cycle. After that ended, they no longer needed our help. How does the government continue to control the world? Well, we'll let you sell our products in our country, but you have to do what we want. And that's what happened. And up until the 1990s, that change was apparent. The outsourcing of American manufacturing was the worst thing because a lot of the country went broke. And of course, as these companies went bankrupt, even family members who had factories and friends, their relatives who had factories, they no longer could stay in business by the year 2000 to 2010. It was apparent that the government was not going to change and to help that industry. However, what they did do to help the economy between 1992 and 94, the initiative was to allow a real estate boom. And so what did that president do that got elected? Well, he got elected on the basis, we will help you buy your first house and we will help you go to college. And that was pushed into our face that everyone had to go to college. And it was very sad for the people that didn't go to college because they were left behind in our society. However, just because someone goes to college, it doesn't say that you're smarter or you're better. It doesn't mean anything. The fact is that plumbers actually make more money than people that work in offices and have a college degree. And so that actually didn't change. So with that change that happened, the companies that were going bankrupt, all those manufacturings, they were also not able to pay out the people's pension that they employed. And millions of people in the US lost their pensions overnight. Now that really affected people who were in their 50s or about to retire because they had no pension left. So the government changed the law in the 70s, early 80s, I believe it was the late 70s. And from that change, it sparked the investment bank era. Prior to that era, they were known as the savings and loans because people were able to put their cash into the bank account and earn interest, 8%, 9%. They were able to buy a CD at 8%, 12%, whatever it was. And to someone that's retired, that's a lot of money, especially if you have your house paid off and your car. So with that change that happened, if you speed it up to 2000, the hedge funds started to grow because of all those people in the 90s and the 80s that were laid off. They couldn't get a job in the investment banks because the investment banks, they have this thing where once you turn 40 years old, you're a has-been. And when you think about it, once you're at the company for so long, if you can't move up to a director position, then you're left out. And because of that change, as you get higher in your career, you have less ability to grow in your career. Unfortunately, if you're not the type to be a director or regional director, if you don't have that dominant quality, they're not going to hire you to do that. And of course, we understand in other videos that I spoke about why they always promote the wrong person. And in fact, they always promote the dominant person. And that dominant person, how did they get there? Well, they got rid of their competition. Hold that thought. So in other words, the dominant person in the group is only good at getting rid of their competition. What happens to the competition? They leave the company because they get ulcers dealing with these people. These type of people that are monsters, they will do everything they have, say everything that they can say to get rid of their competition. And they will literally brainwash you to believe that your coworker is not good enough. But that's not true. And so as this keeps happening, you have only the dominant people that rise, and then they eventually get rid of each other. But what does that do for the management quality of the company? It diminishes the quality of the company because all the qualified people left the company or they tried to get a job elsewhere. And it just repeats itself. So you people out there, if you couldn't get a job after 45 years old, 50 years old, it had nothing to do with you. It just has to do with this awful cycle that we have as humans, that we will only promote the dominant person. That's not actually how things should happen. It should be that the qualified person gets the job, the most knowledgeable, not the one that could talk their head off and be a dominant character in the group and take charge. No, you want qualified people. Where did all those people go? They went into the hedge fund industry. Those people who could not get a job, or they were just an entrepreneur type and they weren't going to put up with that fighting and that catfighting in the office, They went and opened up their own investment company. That's called a hedge fund today. The real term of a hedge fund is called an investment company. An investment bank is a company that is like Merrill Lynch or Goldman Sachs, etc. But an actual investment company is like Bridgewater, Citadel, etc. I'm only naming the top 10, but there's thousands in America. There's over 20,000 hedge funds. And some of them are private. We don't even know that they exist because they're only trading their family's capital, or they're trading a certain amount of capital and they're not open to the public. And that's what sparked the hedge fund era since the year 2000. And 2013 was a major change in that era for hedge funds, because we've seen the collapse of the investment bank, and investors started to question, well, is it possible that investment banks were not capable of managing risk? And that was the outcome. They weren't. Whereas the hedge funds in that era, they didn't go bankrupt. They actually did really well, a lot of them. Not all of them, because not all of them have that strategy that is going to produce a really high return in a collapsing market. Whereas that strategy that may not do really well in a collapsing market, they're able to have a high quality return, a market condition that trades sideways. Like in 2023, this market is going to be trading sideways. So those that did well in 2020 may not do well in 2023, etc. And so these are all things that you as the investor have to understand. There is a major change and there is a major difference between hedge funds and the investment banks. The investment banks, they are incapable of managing risk. And I say this with evidence, with proof, with my PhD research. You could read my dissertation. It's published at the Library of Congress. You could read my first book. It's on Amazon, etc. Whatever you want. Or you could listen to me on here, and I'm telling you. Why is it that the investment banks, such as a mutual fund or a trading desk at an investment bank, is incapable of managing risk? Okay? Now, there's a huge difference. If you don't agree with me, do thumbs down, and if you agree with me, do thumbs up. Whether you do thumbs up or thumbs down, that's still helping me. Now, at a hedge fund, what is a hedge fund? Well, it's an investment company. You have a trader that owns the company, or somehow someone with a lot of money decides to find a trader and they establish their own hedge fund. But that's not something that they should be doing. Wealthy people who have a lot of capital should be investing in the funds of funds. That's a portfolio of hedge funds. Because what if you put 10 million or 15 million in a hedge fund that you start with the trader, and all of a sudden you realize a trader can't trade with a lot of capital? Exactly. These are things that happen. So people with a lot of money, they should focus on the funds of funds business, because they produce a high quality return with a very low risk. Why is that? Because it's a portfolio of hedge funds. And when you have 10 hedge funds trading in that portfolio, and you're a doctor of hedge fund selection like myself, you are able to produce a really good quality return. And this is very important, because hedge funds, we know it today, they didn't all go bankrupt in 08 and 09. And because of that, clearly they were able to manage their risk. What is risk in a hedge fund? Well, it's very simple. It's managing a losing trade. A qualified trader who has experience in a full market cycle, okay, they are capable of producing a return in any type of market condition. They are capable of managing their risk, because they're not using the old risk measures that they have been using in the investment banks for years and years and years. If a trader can't manage their losing trade, well, they shouldn't be trading. And hold that thought. So in other words, for a hedge fund to start, they already have 4 to 5 years experience trading prior, okay? Minimum of 5 years, number one. whether they're trading other people's assets in managed accounts, or they actually establish their hedge fund. But again, you investors are not going to invest in a hedge fund that's only 5-6 years old. You don't do that. They need to show you that they're capable physically, visually, in the returns, that they're able to manage the losing trades in all the different type of market conditions, okay? That's number one. So, in other words, if a hedge fund has 5 years experience or 7 years experience with an opened hedge fund, the structure and everything, and you look at their returns, well, it's evident they're qualified. Not looking at the education of a hedge fund manager, because if you are only qualifying those who went to Harvard, well, that's prejudice. So in other words, you don't qualify me because I went to Long Island University? Well, that's not Ivy League. Well, hold that thought. Ray Dalio went to Long Island University. He went to the same university that I went to. Evidently, he has the world's largest hedge fund. I mean, it's what, 140 billion? So again, looking at a hedge fund's education, no, unfortunately. Richard Dennis proved that to be wrong. Richard Dennis made a bet, and that bet was with Bill Eckhart. Bill Eckhart said, you could teach anyone a trading strategy, but Richard Dennis says, no, you can't. And he said it was an innate ability to trade. Richard Dennis is right, okay, because you're born with that innate ability. However, it's a trait. Whereas Bill Eckhart, he was right, you could teach anyone a strategy. But to deal with the stress, you're born with the ability and the trait to deal with stress. Fast forward in today, part of my PhD research was to research whether or not that's true. And it's true. You are born with these qualities. There's evidence out there that suggests that just because you teach someone a trading strategy does not mean they're going to be successful. So, hold that thought. Now you go to the investment bank and you have to question yourself, well, how did those traders start, okay? Here's how they start. I worked on the trading floor of a top investment bank. It was the top 2 investment banks. There's only 2 that are the best, and they're still around. I can't believe it. On the trading floor, you are either hired as an assistant trader by your best friend, or the fact that your father is a billionaire, or possibly you have a father who's an attorney on the acquisitions department and he helps his daughter or son get a job. Whatever the story is, you could guarantee you most of those kids are hired through friends or somehow have a connection. And those people who aren't hired through a connection, recruited from the best universities, such as Ivy League, unfortunately. And looking at thousands of applications and looking at a student's grades, that doesn't qualify them to actually be successful as a trader. Having high grades is a certain ability, okay? That person has a huge short-term memory. The person that's an entrepreneur that's going to improve what they know has the long-term memory and they're highly visual. So in other words, all right, so we do have Ken Griffin. He went to Harvard and he became very successful at 60 billion or 80 billion, whatever he is at today. But the fact is that he clearly was an entrepreneur. So his brain is probably 60% long-term and 40% short-term. And why I say this is because Ken Griffin, as soon as he finished Harvard, he started Citadel that year. I don't know if he was still in college or whatever it was, but he never went to an investment bank. So when you think about, oh, what's the experience of the hedge fund manager and what's where did that person work? That means nothing. Because just because you work at an investment bank for 20 years, that doesn't qualify you to be a trader. It doesn't even qualify you, even if you have been working at the investment bank for 10 years. Now, of course, that's a huge career, because according to the Book of Occupational Titles, your average time there will be 2.5 years, average. You do last 5 years, but if an investment bank has you on their desk for 5 years, they can replace you with someone younger and less expensive. And so that's why a lot of people don't last that long. Secondly, just because they have high grades, it doesn't mean that they could handle the stress that the trading desk gives you. That's a lot of stress for certain people. However, for Ken Griffin, for Ray Dalio, and all these hedge fund managers, they are able to process stress in a different way. And it's really important for them to process stress in a different way. I could guarantee you, both Ken Griffin and Ray Dalio, I'm only talking about them because that's the names I like talking about, and you could guarantee you they're able to process stress very calmly and very logical. So they are both very logical people. And again, smaller hedge funds that are just starting out, you are also very logical, you have a lot of ambition, and you're an entrepreneur, because you realize it's a waste of time working at an investment bank to try to gain experience to please your investors, when you could start trading because you have the ability to, and start making a return and start your career as your own hedge fund. Of course, you're going to start out in a separate managed account with a client or two or whatever it is, or you have a wife or a husband or family members that have a lot of money, that you start a separate managed account and you start trading their capital in their own account. And then after you get 5-6 years experience, then you present that to larger investors, and you could start raising capital within a hedge fund structure. Again, for an investor, you need to understand this, that there is a big risk factor in the mutual funds, whereas a hedge fund is very different, the risk of a hedge fund. And the term that it's risky, you're going to lose all your money, that's not true today. The fraud has diminished a great deal because the SEC requires hedge fund managers to have an independent audit every year that they have to pay for, a independent administrator, and an independent accountant, okay? So when you understand this, of course your money's still there. Now, of course, yeah, it doesn't mean that, they're going to produce a 20% return every single year in every type of market condition. But why are you investing in one hedge fund? If that's your first investment, you shouldn't be doing that. You should be investing your capital to make a gracious return in a funds of funds. And that's because they have less risk compared to one hedge fund or even 10 hedge funds. If you have $100 million and you are taking $10 million and investing it in 10 different hedge funds, you're still having high risk, because you are not Dr. Hedge Fund that's capable of selecting and deselecting those funds. You don't understand risk on how to analyze risk. It has nothing to do with their traditional risk measures that they're posting on their fact sheet. I proved that to be out of date in today's market with my PhD research. And so you don't have the updated theory how to select and deselect a fund for your portfolio. And that's why you shouldn't be investing in hedge funds. You should be investing in the funds of funds. Forget about the double fees and all that stuff, because the risk is so minimal, as well as the person selecting the funds for that portfolio is highly qualified. They're going to produce a better return. Now, of course, don't ever think that, it has a 10% return in any year and that's low risk. No. When the markets are moving, such as 2020, that portfolio better be doing really well. And so that's the difference between a investment bank, mutual fund, and a hedge fund. It's a huge difference. Hedge funds provide quality returns, and it is time now that the SEC changes the law that states that investors that are not accredited investors can start investing in the funds of funds business. Because if you have $1 million or 200,000, that doesn't mean that you're qualified to lose everything if you have $1 million, or you're not qualified to lose everything if you only have $200,000. Make sense? So the SEC has to wake up. The SEC has done a great job in making sure that the hedge funds don't commit fraud by stealing people's capital, and that's another thing for foreign investments. The SEC is the greatest government agency in the world that has made sure that you are not going to lose your money. Now, of course, they have to regulate cryptocurrency funds, so I'm sure in the future there will be much more more regulation so that we don't have another situation like Sam Bankman-Fried. That was a disaster what he did. If he was really smart, he would have actually put people on his team that knew how to trade, but since he was greedy, he didn't. He had a gift, and Sam Bankman's gift was the ability to raise capital. Sam Bankman raised over, I think, $30 billion in 2 years. I'm getting some mixed amounts, whether it's 40 billion or 10 billion, whatever it is, that's a lot of money to raise in just 2 years. So for you European investors, Asian investors, any Brazilian investors, whoever you are, the American hedge funds is the place because they are heavily regulated by the SEC. I want to thank you so much for watching my video. Please remember to do thumbs up. It's right there. That will really help me out if you press that button. And please subscribe to my channel. You're going to get my videos anyway, because that's how the algorithm works once you click on one of them. But if you subscribe to my channel, I'll get credit for it. Thank you so much.